Tax credits and deductions. As a rule, tax credits are more valuable than tax deductions. A tax credit reduces your total tax bill by the full amount of the credit. A tax deduction reduces your taxable income by the amount of the deduction. Example, tax credits versus tax deductions. Brian is in the 28% tax bracket. A, how much does a $1,000 tax credit save him? And B, how much does a $1,000 charitable contribution, which is tax deductible, save him? We will answer parts A and B for the case in which Brian itemizes deductions and for the case in which he uses the standard deduction. Solution. A, the entire $1,000 tax credit is deducted from the bill and therefore saves him the entire $1,000 whether he itemizes or takes the standard deduction. Part B. The $1,000 deduction reduces his taxable income and not his total tax bill by $1,000. For a 28% tax bracket, at best, the $1,000 deduction will save him $280, and only if he itemizes his deductions. However, if his itemized deductions are less than the standard deductions, then his contribution will save him nothing at all. Example, varying value of deductions. Will is in the 15% marginal tax bracket. Charlotte is in the 35% marginal tax bracket. They each itemize their deductions. They each donate $5,000 to charity. Compare their true costs for their charitable contributions. Solution. Will's contribution saves him $750 in taxes. How? Because he's in the 15% tax bracket, so $5,000 times 15% is a $750 deduction. The true cost of his contribution is $4,250. That is, the $5,000 he donated minus the $750 in tax savings. Charlotte's $5,000 contribution saves her $1,750 in taxes. That is $5,000 times the 35% in her tax bracket. Thus, her true cost of contribution is $3,250. That is the $5,000 she donated minus the $1,750 savings in her taxes. The true cost of donation is lower for Charlotte than Will because she is in a higher tax bracket. Social Security and Medicare taxes. Some income is subject to Social Security and Medicare taxes, which are collected under the name FICA, Federal Insurance Contribution Act taxes. FICA applies to the following: income from wages, including tips, and self-employment. FICA does not apply to the following: income from interest, income from dividends, and profits from sales of stock. FICA tax rates: 7.65% on the first $127,200 of income from wages, with employer matching the 7.65%. 1.45% on any income from wages in excess of $127,200, with the employer matching the 1.45%. The self-employed must pay both the employee and the employer shares at 15.3% on the first $127,200 and 2.9% on any income from wages in excess of $127,200. Example, FICA taxes. In 2017, Jack earned $35,000 in wages and tips as a social media coordinator. He is single and takes the standard deduction. A. Calculate his FICA taxes and his total tax bill, including marginal taxes. And Part B. What is his overall tax rate on his gross income, including both FICA and income taxes? Part A, the solution. FICA tax is equal to the 7.65% times his income of $35,000, which is $2,677.50. Let's compute his taxable income. That will be his earnings, which was $35,000, minus the $4,050 and $6,350. The exemption and standard deduction, which will result in a taxable income of $24,600. Now, to compute his income taxes, he will pay 10% up to $9,350 of his earnings and 15% on the rest. That is $24,600 minus $9,325, which equals $15,275. So his income tax is 10% times $9,350 plus 15% times $15,275. Compute using your calculator, and we get that his income tax is $3,226.25. Thus, his total tax is the FICA plus income tax, which is $2,677.50 plus $3,226.25, the sum of which is $5,903.75. Part B, what is his overall tax rate on his gross income, including both the FICA and income taxes? For the solution, let's recall that from Part A, his total tax is $5,903.75. To compute the total tax rate, you take the total tax and divide it by the gross income, which is then $5,903.75 divided by $35,000. Compute in your calculator, and that is approximately 0.169. Thus, his total tax rate is about 16.9%. Dividends and capital gains taxes. Dividend on stocks is a sum of money paid regularly by a company to its shareholders out of its profits or reserves. Capital gains are profits from the sale of stock or other property. Short-term capital gains are profits on items sold within 12 months of their purchase. Long-term capital gains are profits on items held for more than 12 months before being sold. Tax-deferred income. Tax-deferred savings plans allow you to defer income taxes on contributions to certain types of savings plans. These include the following: individual retirement accounts. They're often called IRAs. Qualified retirement plans, often shortened to QRPs, and 401k plans. Example: tax-deferred savings plan. Derek is single and has a taxable income of $75,000. He contributes $6,000 monthly to a tax-deferred savings plan. How do the tax-deferred contributions affect his monthly take-home pay? Solution: the 2017 marginal tax rate for his income is 25%. Each contribution reduces his tax bill by 25% of $600 or $150. $600 goes into your tax-deferred savings account. His paychecks go down by only $600 minus $150 or $450.